Welcome to today's deep dive. Usually when we talk about reading a corporate earnings report, there's this expectation that it's going to be like reading a thermometer. You just, look at the number, it tells you the temperature of the business, and you move on.
Right. Yeah. It implies this very neat, very linear world where revenue goes up, profits go down, and that's it.
Exactly. It's very static. But then you step into a landscape that's defined by massive, unpredictable geopolitical volatility, and suddenly that thermometer is, well, it's completely useless.
Yeah. You aren't reading a thermometer today. We are looking at a seismograph right in the middle of a global earthquake.
That is a great way to put it, because you are here today to cut through all that polished corporate jargon and get to the real mechanical story behind the numbers moving the global markets. So today is Friday, May 1st, 2026, and the source anchoring our deep dive is a hot off-the-press earnings call presentation from ExxonMobil covering their first quarter 2026 results.
And, it is arguably one of the most revealing documents about the current state of the global economy that we've seen all year.
It really is. So our mission today is to unpack how this massive global energy giant is navigating a world of unprecedented supply chain volatility and chaos, really. And we're going to look at how they are somehow still managing to deliver a staggering 42% total shareholder return in a single quarter, despite all that chaos.
Yeah, that 42% figure is it's wild when you look at the context.
Right. So we'll decode the financial fortress they've built, the geographic hedges keeping them afloat, and their incredibly ambitious roadmap for 2030. Let's start with the sheer scale of the macro storm raging outside and contrast that with the micro reality of Exxon's balance sheet.
The contrast there is just stark. If you read the global market landscape described in this presentation, it reads like a crisis report. We are looking at systemic, massive supply disruptions. Like the presentation notes that global crude supply decreased by about 10%.
Okay, wait, we really need to pause on that 10% figure. Because in the context of global energy, that is not a minor dip.
Oh, not at all.
Because the global energy market usually balances on this razor's edge of, a 1 or 2% surplus or deficit. So a 10% drop in crude supply means millions of barrels are just suddenly missing from the global daily diet. That's the kind of shockwave that alters national economies.
Exactly. It forces this immediate panic response in the spot markets.
Oh.
And, it doesn't stop with crude. Global LNG, so liquefied natural gas, that supply dropped by roughly 20%.
Wow. 20%.
Yeah, and as a direct mathematical result of those physical shortages, crude prices saw their largest ever monthly gain. The physical commodity simply became scarce, and the pricing algorithms just overcompensated violently.
And the ripple effects of that kind of violent swing, they're everywhere. Like the presentation details how in the Asia-Pacific region, refining runs are down 10%.
Right.
And chemical plant rates in that same region were hit by up to 30% due to feed shortages. So we aren't just talking about prices being uncomfortably high here. We are talking about raw materials literally not being available to keep industrial manufacturing plants running at capacity.
Yeah, they are literally powering down their machines. The world is essentially scrambling for basic energy inputs. Entire regions are throttling their manufacturing capabilities just to cope with the lack of supply.
It's grim. But, and this is the crazy part, when you turn the page to Exxon's actual financial results for this exact same period, the panic just vanishes.
It really does. The numbers are almost eerily calm.
And relentlessly positive. Despite this global meltdown, Exxon generated $8.7 billion in cash flow from operations. And here is where the mechanics of high-level finance get fascinating. The presentation points out that this number would actually jump to a massive $13.8 billion if you exclude something called margin posting.
Yes, the margin posting, that's a huge detail.
So let's break this down for you. A margin posting, in this context, is it basically like putting down a massive multi-billion-dollar security deposit to protect yourself in a highly chaotic, fluctuating market? Is that an accurate way to look at it?
That is the perfect way to understand it, yeah.
Yeah.
Because when a market becomes as violently volatile as the energy market did in Q1 2026, the regulated futures exchanges, so places like ICE or the Chicago Mercantile Exchange where these massive contracts are traded, they become incredibly risk-averse.
Makes sense.
Right? They need absolute certainty that the companies making these massive multi-billion-dollar trades can actually cover their bets if the spot price swings wildly against them overnight.
So the exchange essentially freezes the game and demands proof of liquidity. They just say, show me the cash right now.
Exactly. They demand cash collateral up front. That is the margin posting. So the fact that Exxon could casually pull $5.1 billion in liquid cash, posted as a security deposit with these exchanges, and still report $8.7 billion in operational cash flow, that proves a vital point about their corporate strategy.
It demonstrates an industry-leading balance sheet capacity, right?
Completely.
Yeah.
They possess the sheer financial density to absorb collateral shocks that would completely drain the liquidity of a smaller, less capitalized competitor.
It's the financial equivalent of having a shock absorber the size of a building. And we see that weight reflected in the bottom line earnings, too. The presentation lists their GAAP earnings, which is the standard accounting figure, at $4.2 billion for the quarter.
Right. But GAAP includes all sorts of non-cash write-downs and one-time accounting shifts.
Yeah, so if you strip away what they call identified items and estimated timing effects to look at just the core operational engine, like the actual cash of the business of pumping and selling oil generated, that number jumps to $8.8 billion.
And they aren't just hoarding this massive influx of cash in a corporate vault either. I mean, they delivered $9.2 billion in shareholder distributions this quarter.
Wow.
Yeah, that includes $4.9 billion in aggressive share buybacks. They're utilizing the chaos to consolidate ownership and reward the remaining shareholders.
Which perfectly explains how you arrive at that remarkable 42% total shareholder return in a single quarter. But, this begs a massive logistical question. You don't just magically generate billions in operational cash when 10% of the world's crude vanishes and supply chains are collapsing.
Yeah, you definitely don't.
How did Exxon actively offset these massive global disruptions to actually achieve those numbers?
Well, they managed it by completely leveraging what they call their advantage assets. They aggressively localized their focus to the Americas. This is essentially their primary geographic hedge against all that Eastern Hemisphere volatility.
I really want to visualize this strategy. So if the global energy market is a vast, interconnected city power grid, and the eastern sector of that grid keeps suffering massive, unpredictable blackouts, Exxon basically built an independent, fireproof microgrid in their own backyard to offset those global losses.
Yes, an independent, highly lucrative microgrid is exactly what they built. And this America strategy, it relies on three highly productive pillars.
Okay, let's go through them.
The first pillar is the Permian Basin, right here in the United States. In the first quarter of 2026 alone, they added 250,000 oil equivalent barrels per day compared to the first quarter of 2025.
250,000 barrels every single day added to the baseline.
It's staggering. The sheer engineering scale required to ramp up production by that much in 12 months is incredible. And they are on a strict, highly disciplined trajectory to hit 1.8 million barrels per day from the Permian by the end of 2026.
That's massive.
It is. They're scaling up domestic onshore production at a phenomenal rate, and crucially, this production is completely insulated from overseas shipping lanes and geopolitical choke points.
Right, the fireproof backyard. Which brings us to the offshore equivalent of that localized control. What is the second pillar of this America strategy?
The second pillar is Guyana. This has become a massive offshore success story for their upstream portfolio. The presentation highlights that they achieved industry-leading reliability and record production in Guyana this quarter. And looking ahead, they are on track to bring a fifth FPSO online in late 2026.
Okay, we need to define FPSO for you because it really highlights how offshore drilling has evolved. It stands for Floating Production Storage and Offloading Unit. So it's not a traditional permanent oil rig bolted to the ocean floor that takes a decade to build.
Right.
It is basically a massive mobile ship that acts as a localized factory. It plugs into the deep water wells, processes the raw crude right there on the deck, stores it in the hull, and then directly offloads it to transport tankers.
Exactly. And the mobility and speed of deployment for these units, it completely changes the economics of offshore drilling. That fifth unit alone is projected to add another 250,000 barrels per day gross to their production.
Wow.
So between the Permian and Guyana, Exxon is flooding their own internal system with highly reliable, high-margin supply that they control from the wellhead to the water.
But pulling it out of the ground is only half the battle, right? The third pillar has to be how they process and export that raw supply to actually capture the final margin. We are talking about the U.S. Gulf Coast and their LNG operations.
You're exactly right. All that raw crude from the Permian needs to be refined into usable products. And Exxon achieved the highest first-quarter utilization in more than a decade at their Gulf Coast refineries.
More than a decade.
Yeah. They are running those massive industrial complexes incredibly hot and efficiently to capture the high refining margins available in the market right now.
And their expansion isn't just in liquid oil either. On the natural gas side, they brought something called Train 1 at Golden Pass online. And, to anyone outside the industry, Train 1 sounds like a locomotive.
Right, yeah.
But in the world of LNG, a liquefaction train is this colossal piece of industrial refrigeration infrastructure. It takes natural gas, supercools it to minus 260 degrees Fahrenheit, and shrinks it to a fraction of its volume so it can be pumped onto specialized ships. So bringing Train 1 online isn't just a minor upgrade, it instantly boosted total U.S. LNG exports by 5%.
It is a massive injection of capacity. And they note that mechanical completion of Train 2 at Golden Pass is already planned for the fourth quarter of 2026.
That's a fast.
It is. And if we connect this infrastructure build-out to the macro storm we discussed earlier, this America strategy is exactly the mechanism that allows them to shrug off a 20% drop in global LNG supply.
Oh, I see.
They are producing their own raw materials, refining their own products, and exporting via their own terminals. They're capturing the massive price premiums created by global shortages while remaining completely insulated from the physical causes of those shortages.
It is a brilliant display of risk management through vertical integration. However, the presentation is very careful not to paint this as a perfect, impenetrable shield.
No, it was me.
Because even with this robust microgrid in the Americas, Exxon is a global company. They still have a massive, unavoidable physical footprint in the Eastern Hemisphere.
They do. As insulated as their America's portfolio is, they still possess a vast array of assets deeply embedded in the more volatile parts of the global grid, specifically in the Middle East and Central Asia.
So let's pivot to the cost of that exposure, because the earnings call presentation was remarkably transparent about their vulnerabilities and the operational hits they actually took this quarter. Middle East assets still represent roughly 20% of Exxon's global oil equivalent production.
Yeah.
You cannot just hide 1/5 of your global output when supply chains fracture.
You can't. You are highly exposed to regional shocks. And the presentation details several specific, really painful disruptions. There were physical attacks in Qatar that directly impacted 2 LNG trains, where ExxonMobil has an ownership interest.
That's serious.
It is.
Yeah.
And to put the scale of that into perspective, those specific assets accounted for about 3% of their entire 2025 upstream production.
They also noted operational disruptions in Kazakhstan and significant weather impacts from Winter Storm Fern, both of which caused notable decreases in their baseline volume. But, this is where the narrative shifts from a purely physical supply chain problem back into a complex financial problem. The physical breakdowns in the Middle East didn't just mean Exxon had less oil to sell. These physical disruptions actively destroyed their financial safety nets.
Yes. This is perhaps one of the most revealing mechanical details in the entire Q1 presentation. Because Exxon relies heavily on financial hedges, these complex paper contracts traded on the exchanges we discussed earlier to lock in prices and protect themselves from sudden market swings.
Right. They sell futures contracts promising to deliver a certain amount of product at a certain price on a certain date.
Exactly. But a financial hedge only protects you if you can eventually reconcile that paper contract with a physical reality. What happened in Q1 was that the physical supply disruptions in the Middle East prevented the actual shipments associated with several of those hedges.
Wait, so the ships literally could not move the physical product out of the region to fulfill the paper promise?
Exactly. The physical ships couldn't sail. And the financial markets, they do not care about your physical logistical problems. When the settlement date arrives, and you cannot deliver the physical product to close out a hedge in a wildly fluctuating market, you are forced to settle the contract in cash at the current highly unfavorable market rate. You take a massive loss.
Wow.
And this wasn't a theoretical, on-paper-only adjustment. The inability to move physical ships resulted in a very real $706 million direct impact to their earnings.
$706 million just vaporized.
Vaporized.
And not because an executive made a bad trade, but because messy physical geography and regional geopolitics simply got in the way of a neat mathematical spreadsheet.
Exactly.
It really shows how fragile these financial instruments become when the physical world stops cooperating. And this actually ties directly into a terrifying hypothetical they modeled out later in the slide deck. They presented a worst-case choke point scenario, specifically detailing what would happen if the Strait of Hormuz closed for an entire quarter.
Yeah, that slide is sobering. The Strait of Hormuz is one of the most critical maritime choke points on the planet for energy transit. And the mathematical damage they modeled, it's huge. If that strait closed for a full quarter, It would reduce Exxon's Middle East production by roughly 750,000 oil equivalent barrels per day compared to their 2025 baseline.
Okay, let's put that number in context. We spent the first half of this deep dive marveling at how they managed to add 250,000 barrels a day in the Permian Basin. A closure of the Strait of Hormuz would instantly wipe out 3 times that amount of production.
Yeah, the localized gains would be entirely eclipsed by the regional shock. And the impact wouldn't be contained to just raw crude extraction either. The model shows it would lower their global product solutions throughput by 3% versus the fourth quarter of 2025.
So that translates to less refined fuel, fewer base chemicals, and just less of everything flowing through their entire global integrated system.
Precisely. It perfectly illustrates the intense push and pull of their current operational reality. They are generating billions in the Americas, fortifying their balance sheet, but they are constantly forced to monitor these massive geopolitical fault lines in the East. It requires a permanent state of crisis management.
Which naturally leads to the overarching strategic question. How do you manage a massive corporation when, structurally, that you are permanently exposed to that kind of violent volatility? You can't just, cross your fingers and hope the shipping lanes stay open.
No, you definitely can't.
You have to systematically change the DNA of how your company generates profit. And that brings us to the final piece of this deep dive, Exxon's 2030 horizon. We are transitioning from the immediate quarter-by-quarter crisis management to their long-term blueprint. How are they engineering the company to not just survive this permanent volatility, but to systematically grow their profitability through it?
Well, the financial targets they have published are incredibly ambitious. They are aiming to deliver roughly $25 billion in earnings growth and about $35 billion in cash flow growth between the years 2024 and 2030.
That's a huge jump. And to achieve those numbers, the presentation leans heavily on a concept that features prominently in almost every corporate deck, structural cost savings. They state they are on track to achieve $20 billion in structural savings by 2030 compared to their 2019 baseline.
Yeah, and there is even a standout statistic claiming their cumulative savings so far are greater than all other independent oil companies combined.
It implies a massive systemic overhaul of their entire procurement and operational spending models. But hold on, I have to play the skeptic here.
Go for it.
Corporate slide decks absolutely love the phrase structural cost savings. So I have to ask, is this just a polite corporate euphemism for slashing essential budgets, deferring necessary maintenance, and aggressively cutting jobs just to pump up the short-term quarterly numbers? Or are they actually changing the fundamental mechanical value of what they do and what they sell?
That is a crucial distinction to make. And look, while there are always efficiencies found in workforce and budget optimization, the data in this presentation points to a fundamental change in the actual recipe of their business. They aren't just putting the company on a diet. They are shifting what the company produces.
Okay.
The proof is in their heavy pivot toward what they categorize as high-value products.
Let's synthesize the difference there. Because a barrel of regular crude oil is essentially a blank canvas. It is a pure commodity. Anyone can pump it, anyone can sell it, and you are entirely at the mercy of the global spot market to tell you what it's worth on any given Tuesday.
Exactly.
But if you take that raw barrel, run it through an advanced chemical plant, and refine it into a highly specialized polymer used in aerospace engineering or advanced medical devices, you have completely removed it from the commodity market. You now control the pricing because you've added irreplaceable intellectual property and specialized chemistry to that barrel.
That is the exact mechanism driving the 2030 strategy. You insulate your margins from the whims of the spot market by manufacturing specialized goods. The presentation notes they achieved record sales volume in specialty products this quarter, and they are already seeing significant startup volume from their new China chemical complex.
So they are replacing low-margin commodity volume with high-margin chemical volume.
Precisely. Their stated goal is that over 40% of their earnings potential by 2030 will be driven exclusively by these high-value products. They explicitly state they aim to achieve over $15 per barrel in unit earnings by 2030. They are structurally changing their profitability.
They are essentially padding their margins with advanced chemistry. By making the output so intrinsically profitable, they create a buffer thick enough to withstand the macro storms affecting the raw inputs.
That's it, exactly.
And they are returning that newfound, chemically enhanced profit directly to the owners. We mentioned earlier the $4.9 billion in buybacks this quarter. The presentation reveals they are actually on pace for a staggering $20 billion in share buybacks for 2026 alone.
$20 billion.
Yeah. That structural profitability is what is driving the 48% one-year total shareholder return.
When you look at the entire 2030 horizon, it becomes clear that their strategy isn't about hoping the world gets less chaotic. It is about building an industrial machine that is highly profitable despite the chaos. They are doing it through lower operational costs, a pivot to high-value chemical products, and a massive, highly controlled geographic anchor in the Americas.
Let's bring all these threads together for you. The core takeaway from unpacking this presentation is that reading an earnings call is never just about looking at the final net profit figure. It is about visualizing the intense, often violent push and pull between geopolitical shockwaves and strategic corporate maneuvering.
Absolutely. On one side of the ledger, you see a 10% drop in global crude and physical attacks on Qatari LNG facilities, pulling the company downward, threatening their supply lines, and testing their resilience.
Right. And simultaneously, on the other side of the ledger, you see massive Permian production spikes, the deployment of Guyanese FPSO units, and a $20 billion cost-saving plan pulling them upward, creating an almost impenetrable financial fortress.
It really is a profound study in how a legacy corporation hedges its bets across a fractured global landscape.
It really is. But I want to leave you with a final lingering thought based on that $706 million hedge loss we dissected earlier. Because we currently live in an era where the global economy is assumed to run on highly sophisticated, digitized financial contracts, paper promises, and algorithms moving at the speed of light.
Right.
But as Exxon's first quarter so clearly demonstrated, when a physical ship cannot pass through a physical strait due to a real-world conflict, those elegant financial hedges instantly collapse. It makes you wonder, as the world becomes more aggressively geopolitically fragmented, will the messy, unavoidable physical realities of geography permanently break the neat mathematical models of global finance?
It's a huge question.
It is, because the numbers on the spreadsheet are ultimately only as good as the physical ships on the water. Thank you for joining us for this deep dive. Keep questioning the numbers, and we will see you next time.